Welcome to the Investor Financing Podcast, where we interview real estate investors and lenders so you can learn all the secrets to getting your projects funded and scale your portfolio. Learn about fix and flip loans, BRRRR financing, rental, fix to rent, commercial, multifamily bridge loans, business loans, and so much more. And now, your host, Beau Eckstein.
Hello and welcome to another episode of the Investor Financing Podcast. And today we're going to talk about multifamily financing. Especially, we're going to be comparing the benefits of credit union financing as opposed to agency debt or bank financing. So the pros and cons of each. So let's kind of start out first here. So why would you want to use a credit union? A lot of sponsors or borrowers are coming to me lately, and they're looking for kind of like value add bridge money where they're buying a property, they're going to be stabilizing and raising rents and turning over some properties. The occupancy level could be 90% plus, and most of the time they're looking for maybe a Fannie or Freddie loan. But the problem is they're going to be stuck in a 5-year prepayment penalty. And right now I'm talking about loans that are $5 million and less typically. And so a better option is some of my credit union partners, they don't put prepayment penalties on their loans, right? So if you're doing one of these value add plays, it's not a heavy push, a heavy lift. They're advantageous on a lot of these cases. And what I like about credit unions, obviously no prepayment penalties. They'll go anywhere from 20 to 30 years on amortization. Hopefully the longer the better. They don't do interest only, which is one of the downsides. But if you're going in with the anticipation of refinancing on year 3 or 4, instead of paying a very expensive yield maintenance prepayment penalty or declining prepayment penalty, credit union is a perfect fit.
You're listening to the Investor Financing Podcast. We'll be right back after this break. Are you looking for funding? Are you getting frustrated trying to find a lender? Visit investorfinancingpodcast.com and click the Get Funding button. Complete the simple form and schedule a free phone consultation with one of our placement specialists. We have a proprietary directory of funding partners that can help you get the funding you need. It's fast and easy to explore the options available for your specific needs. Don't wait. Visit investorfinancingpodcast.com and get connected.
Now, why wouldn't you want to use a credit union? Well, maybe you want interest only for the first couple of years, right? Maybe you want a 30-year term and this property's older and you can only get a max of 25-year AM. So there's differences, right? So as we're discussing and looking at the property, we're looking at rent rolls, we're looking at what the CapEx or the rehab budget is. We're constantly figuring out, okay, what would make the most sense? What's going to be the easiest? Do you have experience? If you don't have experience, like owning a similar like property or have the net worth equivalent to the loan amount or greater within the sponsorship team, you're not going to get agency debt, right? So, and so we're kind of looking at these different buckets. And sometimes it's a bridge bucket, right? Sometimes the bank or credit union or agency is not going to work. Occupancies at 70% or 60%. It's a heavy value add. Those are the time for a bridge loan. We have bridge partners that will lend up to 85% of costs for our bigger deals. So like if you're doing a 5 million plus acquisition, we can go up to 85%. The pricing on bridge loans obviously is not as attractive, but less cash in, right? Because they're lending you maybe 85% of costs, 85% of purchase, 85% of the CapEx or rehab budget. So when we're talking with you, that's where we're intaking this information so we can kind of steer you into the right lending program or give you a little guidance, because there's differences and certain characteristics of community banks and credit unions, and knowing which bucket you're going to really ideally fit into with the least headache and obviously the best returns, because you're able to structure a loan with your game plan. I've seen so many people having to pay off huge prepayment penalties, like $1 million plus, on these bigger loans because they decide to sell and now they're paying these prepayment penalties. So figuring this out in the beginning is the best way, because then year 3, year 4. Now, if it's a long-term hold and it's going to be a long-term hold, then there's, potentially and the property stabilized and it's in good shape, possibly HUD is the best option, right? But you got to kind of know when it is and when it isn't the best option. So there's all these different buckets. There's bridge lenders. They're depending on loan amount, depending on the sponsor's net worth and scheduled real estate owned and experience, right? So that's what we do, and we find the best loan. That's what a good mortgage advisor is going to do, is figure out exactly where you're at right now, where the property's at right now, and then work backwards and figure out what the best pricing is too. The other thing we do is we're constantly talking with different lenders, because every lender's got a different appetite. Like local community banks only lend in certain areas, but some of them are extremely aggressive. Some of them will lend 80% of costs, including the CapEx and rehab. So knowing these, details, and having these connections with the banks, credit unions, and the account executives is what helps us place your deals and get you the best financing possible. So really, initial conversation is, okay, here's my background, here's what I've done, our whisper price to buy this property is X, it needs X in CapEx, the current occupancy is X, the rents are $150 under market. These are the things. We can have basically a 10-20 minute conversation. We can get the general. Obviously, we're going to ask for a rent roll, current rent roll. We're going to ask for 2 years P&Ls, current interim financial statement, sponsors, PFS, personal financial statement, and maybe a resume is helpful. And then any pictures you have on the property or an OM, right? That we can quickly assess which bucket your loan request most likely will fit in and give you kind of instant feedback. And then after we package the deal, we'll send out for initial feedback with our partners and see, where they're coming in with rate and terms, and basically narrow down those 3 or 4 or 5 lenders into 1 or 2 that are most realistic, that, 1, like your deal, and 2, have the best terms. So that's exactly what we do to size up your deals. I hope this was helpful. I like doing these short little, get to the point and hopefully give some value to you. But anyways, feel free to share this podcast or this YouTube show. And if you've gotten any value out of it, and please subscribe, make sure you hit the subscribe button, and I will see you on the next episode. Thank you very much.
Thanks for listening to the Investor Financing Podcast. For show notes and useful resources, please visit investorfinancingpodcast.com. For questions or comments, email info@investorfinancingpodcast.com. If you enjoy our show, please share it with your network. Until next time.